Are retirees ready for a tax shock that could cost thousands if they aren't prepared? In 2025, the One Big Beautiful Bill Act, OBBBA, has dramatically changed the tax landscape for retirees. This isn't just about small rate adjustments. It's a web of new phaseouts, deductions, and planning rules that could make or break your retirement finances. Tax expert Bob Keebler warns that navigating these changes without professional guidance could be risky. Every decision, whether it's taking a distribution, converting to a Roth IRA, or timing deductions, can ripple across your entire tax picture. Every time you pull one lever, another lever moves, Keebler explains, emphasizing the need for careful planning and the use of proper software to avoid costly mistakes. The stakes are high. Retirees who fail to understand these changes could see deductions vanish, income unexpectedly spike, or even face higher Medicare premiums. But among all these changes, a few key areas stand out, starting with one of the most talked about shifts this year, the SALT deduction. One of the biggest headlines for 2025 is the increase in the state and local tax deduction, known as SALT. Under the OBBBA, the cap jumps from $10,000 to $40,000, a massive boost for retirees who itemize. But it's not as simple as it sounds. High earners face a phase-out. Once your income exceeds $500,000, the $40,000 cap begins shrinking, dropping back to $10,000 at $600,000. Keebler warns this can create a hidden trap. That journey from $500,000 of AGI to $600,000 can actually raise your taxable income by $130,000 because you lose that $30,000 deduction, he explains. Planning carefully is essential. Timing your payments and deductions could save you thousands. For example, it might be smarter to push some deductions into the following year if local laws allow it. The SALT increase offers opportunity, but also complexity. Missteps can turn a helpful deduction into an expensive mistake. And while SALT grabs attention, retirees also need to consider another powerful lever in their tax strategy: charitable giving. Charitable giving has become one of the smartest levers retirees can control under the new tax rules. With the standard deduction now climbing to about $32,200 for married couples in 2026, many retirees may not benefit from itemizing every year. That's where a strategy called bunching comes in. Bunching means making large charitable contributions every few years instead of spreading them out annually. For example, you could donate heavily to a donor-advised fund in year 1, then let the fund distribute gifts over the next 2 or 3 years. This approach allows retirees to maximize deductions when itemizing, while still taking advantage of the standard deduction in other years. Keebler emphasizes that charitable contributions aren't just a way to give back, they're a critical planning tool. Done strategically, they can help control taxable income, protect eligibility for other deductions, and even minimize Medicare surcharges. But charitable planning is just one piece of the puzzle. Retirees also need to carefully navigate Roth conversions, which have become trickier under these new rules. Roth conversions remain a powerful strategy for retirees, but under the 2025 tax changes, they require careful planning. Multiple phase-outs now affect how much you can convert without unintended consequences. Keebler advises testing conversions incrementally, say $20,000 at a time, to see how each move impacts your overall tax picture. Even a small misstep can ripple across your finances. A Roth conversion could affect your SALT deduction, senior deduction, or even your IRMAA payments for Medicare. For higher-income retirees, this is especially critical because IRMAA surcharges are based on modified, adjusted gross income from 2 years prior. Going slightly over a threshold could raise monthly Medicare premiums by $150 to $200 or more if both spouses are covered. The takeaway: Roth conversions aren't one-size-fits-all. Every step must be carefully tested to balance tax advantages with potential costs. But Roth conversions are just one part of a broader toolkit for navigating the 2025 retiree tax landscape. Next up is a brand new deduction designed specifically for seniors: The 2025 tax changes also introduce a new $6,000 deduction for seniors, $12,000 for married couples, stacked on top of the standard or itemized deductions. At first glance, it looks like an easy win, but there's a catch. The deduction begins phasing out once your modified adjusted gross income, MAG, exceeds $150,000. That means retirees must carefully plan distributions, securities sales, and Roth conversions to avoid unintentionally losing this valuable benefit. Even small miscalculations could push income over the threshold, reducing or eliminating the deduction entirely. Keebler stresses the importance of staying disciplined and coordinating every move across your tax strategy. This senior deduction offers a powerful tool, but only if you use it wisely. Missed opportunities here could cost thousands. And while seniors focus on this new benefit, it's clear that every decision in the 2025 tax system affects another part of their financial picture, creating a web of interactions that requires careful navigation. Keebler emphasizes that navigating the 2025 tax landscape isn't something you can do with spreadsheets alone. Every lever, SALT, charitable giving, Roth conversions, senior deductions, affects another, creating a complex web that can quickly overwhelm even experienced retirees. Using professional software and consulting a qualified CPA is essential to avoid costly mistakes. Timing is critical. Planning distributions, donations, and conversions in the right sequence can save thousands and prevent unintended tax consequences. Testing each scenario incrementally ensures you don't inadvertently push income over a threshold, trigger higher Medicare premiums, or lose valuable deductions. The key takeaway: small missteps can become expensive. With careful planning and professional guidance, retirees can turn 2025's complex rules into opportunities, maximizing deductions, controlling taxable income, and protecting retirement savings. Even with careful planning, retirees face hidden risks in 2025 that could derail their strategy. Small miscalculations, like slightly exceeding income thresholds or mistiming a Roth conversion, can trigger unintended consequences, from losing deductions to higher Medicare premiums. Keebler warns that every financial move interacts with multiple parts of the tax system, creating a chain reaction that's easy to underestimate. For example, a $100,000 Roth conversion might seem harmless, but combined with other income or deductions, it could push a retiree over a phase-out limit, resulting in thousands in additional taxes or surcharges. The complexity of these interactions makes professional guidance not just helpful, it's essential. The lesson is clear. Retirees need to stay vigilant, test every strategy, and anticipate the ripple effects of each decision. Missing even one detail could be costly. And as 2025 unfolds, the question remains: will those who plan carefully stay ahead, or will the unexpected tax traps catch them off guard? Finally, the key to navigating 2025 isn't just understanding each individual rule, it's seeing how they all fit together. SALT deductions, Roth conversions, charitable giving, and the senior deduction all interact, and even small errors can cascade into big financial consequences. Keebler's advice is simple but critical. Plan early, test every move, and coordinate with a qualified CPA to avoid costly surprises. Retirees who act strategically now can protect their wealth, maximize deductions, and even turn these complex rules into opportunities. The difference between careful planning and oversight could be thousands of dollars, and more importantly, peace of mind for the future. The final question hangs in the air. Will you take control of your 2025 tax strategy and safeguard your retirement, or risk being caught off guard by these sweeping changes? One thing is certain: early action, careful planning, and understanding the hidden levers in your tax plan will define who comes out ahead in the coming year.